Hello, savvy investors. As we approach the final stretch of 2023, I'm delighted to bring you the last video of the year. Today, we're unveiling a promising outlook for 2024, especially for Singapore-listed real estate investment trusts, or S-REITs. Buckle up as we explore recent trends, potential catalysts, and reveal the 3 top REITs that the Dividend Uncle thinks will soar in 2024. But before we dive into today's insightful topic, I want to express my sincere gratitude. The Dividend Uncle channel has recently crossed the incredible milestone of 1,000 subscribers, and I want to thank each and every one of you for your unwavering support. Your engagement, comments, and the community we're building together mean the world to me. It's been a remarkable journey sharing thoughts, analyses, and investment strategies, and I'm thrilled to have you on board. Thank you, once again, for being a part of this growing community. Now, let's dive into today's video that will define our investment journey in 2024. Navigating recent challenges. The year 2023 proved to be a tumultuous ride for S-REITs, and a prime example of this is the CSOP iEdge S-REITs Leaders ETF. At its lowest point, this ETF was down a staggering 16%, sending shockwaves through the investor community. The standout challenge was the surge in interest rates. In the economic symphony of 2023, interest rates took center stage, moving from near zero levels at the end of 2021 to the current range of 5.25% to 5.50%. This aggressive hike, led by the U.S. Federal Reserve to combat inflation, had a profound impact on the REIT landscape. The higher interest rates had a cascading effect, influencing the capitalization rates used in property valuations. As rates increased, capitalization rates, which reflect the return on an investment property, also rose. This, in turn, resulted in declines in property valuations. The repercussions of this were felt across the board, stressing the gearing ratio limits of many REITs. Why REITs will outperform in 2024? Recent weeks, however, tell a different story. The S-REITs index has bounced back from its multi-year lows and is set to end the year flat. This follows the downward trend in global benchmark interest rates. Signs of improvement in U.S. inflation and a more dovish stance from the Federal Reserve are acting as catalysts for this upward momentum. As we gaze into the investment landscape of 2024, a compelling case emerges for the resurgence of REITs. Let's explore the 3 pillars supporting the thesis that REITs are poised for a robust performance in the coming year. 1. Declining interest rate expectations. The tides are turning in favor of REITs with the anticipated decline in interest rates in 2024. The negative impact of higher interest rates witnessed in the past year is now acting in reverse. Lower interest rates forecasted for 2024 will yield several benefits for REITs. Firstly, the burden of interest expenses on floating rate loans is set to lighten, providing relief to REITs. As these entities refinance existing loans, they'll navigate a landscape of lower interest costs. Secondly, the attractiveness of REITs, often measured by comparing dividend yields with the risk-free rate of government bond yields, is poised to increase. As the latter decrease, REITs become more appealing to investors seeking stable returns. 2. Economic soft landing. The economic backdrop of a soft landing, steering clear of recession, bodes well for REITs. In the retail sector, where economic indicators align with easing inflation and increased spending, REITs can anticipate higher rental income. This uptick is fueled by a surge in percentage of sale rent and lease renewals. For the logistics sector, the robust exchange of goods globally and sustained consumer demand through online purchases will be instrumental in maintaining a healthy trajectory. 3. Historically attractive valuations. Zooming out to observe the bigger picture, the valuation of REITs remains exceptionally favorable from a historical perspective. On average, REITs are trading at a price to net asset value, or NAV, ratio of 0.8. This compares favorably against historical average of 1.0. Challenges remained: be selective. While the winds of change blow favorably for REITs in 2024, it's crucial to acknowledge and navigate the lingering challenges for certain REITs. The late Charlie Munger always emphasized that we should think about what not to do first, rather than what to do first. So let's. Firstly, avoid REITs with high gearing and low interest coverage ratios. The risks posed by the relatively high interest rates will be around for a while. This will continue to cast a shadow on the dividend distribution of such REITs. Secondly, avoid REITs with weak operational performances. 2023 was a relatively strong year, with credible economic performances. If the REITs show poor occupancy rates or negative rental reversions, it is likely that the fundamentals of the business sectors it is operating in is weak. In addition, the revaluations that REITs need to do at year-end may spring a surprise on investors. Think overseas U.S. office sector. Thirdly, avoid REITs without a quality management. Proactive managers look ahead and plan ahead of other REITs. REITs with managers who have been bravely recycling assets and deleveraging in the high interest rate environment deserves a pat on the back. The Dividend Uncle's top REITs for 2024. With these considerations, it's time to reveal the Dividend Uncle's top picks which I think will outperform in 2024. These selections are made with careful consideration of various factors, as well as whether they remain undervalued despite recent price appreciations. So, without further ado, let's delve into the chosen ones. 1. Mapletree Logistics Trust, ticker M44U. In the era of booming e-commerce, Mapletree Logistics Trust stands as a key beneficiary, with its focus on logistics and warehousing. Its global footprint provides a strategic advantage, tapping into growing markets beyond Singapore. With a low gearing ratio 38.9% and 83% of debt fixed, it can navigate the interest rate environment with ease. Its management has been actively recycling assets, showing proactiveness and foresight. In addition, even after increasing 18% from its bottom over the past weeks, Mapletree Logistics Trust's price to net asset value ratio is about one standard deviation below its 5-year average, showing that it remains inexpensive from a longer-term perspective. 2. Capitaland Integrated Commercial Trust, ticker C38U. The second REIT is Capitaland Integrated Commercial Trust. Although it has a slightly higher gearing just above 40%, it has a credible interest coverage ratio or ICR of 3.1 times. With a diversified portfolio that includes retail and commercial properties in Singapore, and a high occupancy rate of 97.3%, the REIT is well positioned for a variety of market conditions going forward. In terms of valuation, even though Capitaland Integrated Commercial Trust has surged some 20% from its bottom, its price to net asset value ratio is still one standard deviation below its 5-year average. Looks like its best days are still ahead. 3. Frasers Logistics and Commercial Trust, ticker BUOU. Frasers Logistics and Commercial Trust has demonstrated resilience, even in challenging economic climates, showcasing its ability to weather market uncertainties. The trust's diverse assets, spanning 107 logistics and commercial properties across 5 major countries, offer a balanced approach to income generation. Its gearing ratio at 30.2% is one of the lowest among the S-REITs, with an impressive interest coverage ratio of 7.1 times. Similar to the earlier 2 REITs, its price to net asset value remained one standard deviation below its 5-year average, showcasing the potential for further growth in 2024. Conclusion. As we stand on the cusp of 2024, all signs point to this being the year of the REITs. The aligning factors, from an improving interest rate environment to discounted valuations and operational resilience, position S-REITs for a potential turnaround. But, of course, smart investors remain selective. Identifying counters with low gearing, strong operational performance and relative undervaluation is key to navigating the potential challenges and seizing the opportunities. If you're as excited as I am about the prospects of 2024 for REITs, give that like button a tap, share your thoughts in the comments, and make sure to hit subscribe for more insightful dives into the world of investments. Here's to a promising 2024. Happy investing!